from the heart of where innovation, money, and power collide. In Silicon Valley and beyond, this is Bloomberg Technology with Emily Chang.
I'm Emily Chang in San Francisco, and this is Bloomberg Technology. Coming up in the next hour, he may be the biggest Bitcoin bull there is. At this rate, MicroStrategy CEO Michael Saylor will own 1 in every 200 Bitcoin ever minted. And he's bought more of the dip. But what if it's not a dip? Saylor joins us live, coming up. Plus, as Apple and Google push further into self-driving cars, we'll take a deep dive on the how and the why. It's not just because they want to, according to our own Mark Gurman, it's because they have to defend their turf, as cars are looking more and more like computers on wheels. And Virgin Galactic scores FAA approval to send customers to space before Blue Origin. A victory for Richard Branson, but what does it mean for Jeff Bezos as he prepares for his flight on July 20th? We'll have the full story. We'll get to all of that in a moment, but first let's get a look at how crypto markets ended the week. Our Ed Ludlow has the full picture, and Ed, Michael Saylor coming to us momentarily. What's he dealing with this week?
Yeah, that's the right person to hear from. Look, another down day Friday for Bitcoin, sliding around 8%. We're hovering around 32,000 US dollars. We had this breakout below 30,000 US dollars Tuesday. We rebounded, choppy trading. The main driver seems to be China, the crackdown on mining, the crackdown on financial institutions allowing transactions in cryptocurrency. But what's interesting on the next board is the other asset classes that move with Bitcoin. You see when you slide heavily in the cryptocurrency, the Bloomberg Crypto Galaxy Index, which is 40% Bitcoin anyway, also down significantly, but also those crypto-related stocks, MicroStrategy being one of them, down 5.5% Friday. And the question that I want to pose is, are investors treating MicroStrategy as a proxy for Bitcoin? You see the symmetry in the moves over the last 12 months, different disclosures from MicroStrategy in terms of how much Bitcoin they're buying, how they're buying it for issuing debt. Slight outperformance recently, but that is the question for Michael Saylor. Emily.
All right, and we're going to ask it. Bloomberg's Ed Ludlow, thanks so much. Of course, as Ed mentioned, MicroStrategy upping its Bitcoin position. CEO Michael Saylor confirming the company this week bought just over 13,000 more Bitcoin, making their total stash more than 105,000. That means he'll own 1 in every 200 Bitcoin ever minted, of course, if he never sells. For more on his strategy, I want to bring in MicroStrategy Chair and CEO Michael Saylor himself. Michael, great to have you back here on the show. So clearly you've bought the dip, but what if it's not a dip? How much have you considered the possibility that this is part of a prolonged slide?
Well, we think the primary dynamic is the China exodus. There's a forced and there's a rushed exodus of capital and mining from China that was a bit of a surprise that kicked off in May. And that's driving the dynamic in the market right now. Our strategy is long-term. 10 years ago, I met with you, Emily, and I talked about the mobile wave. And the mobile wave was the dematerialization of music falling to the Apple iPhone and then turning books into iBooks. If you want to give music to 5 billion people, you got to take the music out of the CDs. And if you want to give books and education to 5 billion people, you have to take the words out of the book and you got to dematerialize the library. Bitcoin is the dematerialization of property. We're sucking the value out of gold and real estate and other property assets and collectibles and art. We're putting them on a blockchain. We're giving it to the people. It's a long-term trend. It's 1 million times more efficient than hauling your property around on your back. And if you want to give property rights to 5 billion people, you need Bitcoin to do it and a smartphone. So it's a technology play for us. And we're very confident that over the next decade, 5 billion people are going to have property on a smartphone, and Bitcoin is going to be the primary blockchain that's used to do that.
Michael, I went back to that interview from 2012 to prepare for this one. I remember it. But speaking of smartphones, give us the truth. I mean, how often are you checking your phone and checking the price? Are you losing sleep? Do you meditate? Do you have a stiff drink when the price goes down?
Well, look, I'm not a trader. If I was a trader, I'd have anxiety. That's a difficult job. I'm a technology believer. I bought Facebook before it came public. I bought Apple when it was a couple dollars a share. I held it a decade. This is a 1 decade long trend. MicroStrategies acquired all this Bitcoin with a combination of equity and debt, but the debt is all long-term debt. It's either unsecured convertible bonds that run 5-6 years or secured debt against our cash flows of our software business. We don't mark anything to market. So we're not really concerned about short-term price fluctuations. In 6 or 7 years, yeah, I expect Bitcoin to be higher than it is today. And how it gets there, it'll be volatile.
Now, I know you haven't been a fan of altcoins in the past, but are you considering holding other cryptocurrencies beside Bitcoin? Are you already holding them? If so, which ones?
The way that we look at the digital ecosystem is you've got digital property. That's like owning a block of Cyber Manhattan. You're just owning the Granite City block. One Bitcoin is a block in Cyber Manhattan. Then you've got digital currencies like Tether. They're currencies. There's not much upside. They're just going to be regulated like money market funds in cyberspace. And then you've got digital applications, and they're trying to dematerialize insurance companies and exchanges and banks. They're kind of like the buildings on top of the Granite City block or the business in the building. It's a different thing, you know? If I went to Vegas, I would just want to buy all the land in Vegas. Somebody else might want to build the hotels, the casinos. That's not for us. It's a complicated business. It's a little bit more competitive. We're waiting for a bit more regulatory clarity. If you're going to be an insurance company in cyberspace, there's probably insurance issues or trading issues. We've adopted a very simple strategy. Buy 105,000 blocks of Bitcoin in Cyber Manhattan. We think it's going to be good for hundreds of years, and one day billions of people will want to live there.
But why not then, and this is a question coming in right now from a terminal user, buy other more energy efficient forms of crypto? Are you considering that?
Well, we actually think that the way that Bitcoin mining works is the most energy efficient way to create a trusted digital property network. It's you put in $1, you get out $200 of value on Bitcoin. If Google puts in $1 of energy, they get out $10 of value. It's in fact the most energy efficient industry in the world, and the amount of energy that it uses is a few basis points of the amount of energy used in the civilization. So I'm not concerned about the energy use. There's no more efficient way to do it. If I wanted to run a centralized application, I could do it with less energy, but there's no way that you can create digital property that's going to last for hundreds of years outside of the control of a CEO, a government, or a country that has integrity and durability without using energy.
So what side of the Bitcoin, if you will, do you consider yourself relative to Elon Musk?
What side of the Bitcoin?
Exactly.
I'm
You know, how would you describe your position on Bitcoin relative to Elon Musk?
My position on Bitcoin is it's the dominant digital property network in the world. It's won that race. And if what you want to own is digital property for the long term, then you just buy and hold Bitcoin. I think that Elon Musk also sees Bitcoin as a great store of value, and it's a monetary inflation hedge. And he has expressed concerns about the need to invest balance sheet assets as a monetary inflation hedge. He's got many other businesses that he also evangelizes and is very enthusiastic about. I'm a bit more focused on Bitcoin, I believe.
I know you've been on at least one call together about energy. Are you guys in touch? I mean, do you speak often?
We do. We do.
And what do you talk about?
And Elon's been very enthusiastic about Bitcoin and also about making sure that Bitcoin's a force to drive sustainable energy usage in the world. And I think he's talked about that a bit. I've organized the Bitcoin Mining Council so that we can promote energy transparency and communicate the energy usage of Bitcoin and also show how sustainable it is. In fact, one of the things we found is that the Bitcoin industry is using more sustainable energy than any other industry, and it's getting more sustainable at a more rapid rate. So we look forward to sharing some of those findings shortly with the public.
Let's talk about the crackdown in China on Bitcoin mining. What does this mean for the longer term?
Well, China had 50% market share of Bitcoin, and they were generating $10 billion a year. in a business that was growing 100% a year over year. And the government cracked down on it and they squeezed the entire industry out of China. I think that given the growth rate of Bitcoin, this will prove to be $1 trillion mistake for China. So it's a tragedy for Chinese miners. It's a geopolitical mistake for China, the country, but I suppose they can afford to make $1 trillion mistake. It's a nuisance and a dislocation for Bitcoin in the near term. You see the trading volatility. It squeezed a lot of people a lot of Chinese had to sell Bitcoin and under forcible liquidations with a time frame because they have to get out of the country and all their loans got called. And so that's been a big opportunity for Western investors. Companies like mine bought Bitcoin in the 30,000 range. We would have paid double, maybe triple to buy the Bitcoin if it hadn't been for the China exodus. So we got to benefit from that. And it's a great windfall, Emily, for North American Bitcoin miners because their costs are the same and they're going to generate 50% more revenue or 75% more revenue for quite a while because the Chinese industry has been taken offline.
Now, still, it seems like there's no impetus for a rally on the horizon. Chances are a Bitcoin ETF not getting approved this year. Regulators in the U.S. are also going to tighten up. What drives Bitcoin from here exactly? And when? When do we come out of this?
There's a delay. If you roll the clock back 6 months to 9 months, mainstream media didn't cover the story and people were uncertain about what would happen. Biden being elected president was good for Bitcoin. Gary Gensler taking over the SEC was good for Bitcoin. The new class of regulators are progressive. They're more enlightened. They're more educated on Bitcoin. I think that you will in time see a Bitcoin ETF. You've seen Morgan Stanley and Goldman Sachs and most major banks start to trade in Bitcoin and Bitcoin derivatives and offer Bitcoin mutual funds. There's an avalanche of banks that are going to be offering Bitcoin services. And of course, Coinbase came public and Square and Coinbase are between them, adding millions of new Bitcoin holders every month. And so you just got to be patient and look at the long-term technology trend, which is, do you believe in iBooks and do you believe in the iCloud and do you believe in big tech? Because if you believe those things, the next logical thing to get dematerialized is property on 5 billion mobile phones. Just a matter of time.
Now, I think people forget sometimes that MicroStrategy is a software company in and of itself, and yet it has become a sort of proxy for investors wanting to get into Bitcoin. Do you see that at all as a risk to MicroStrategy shares?
Well, Emily, our stock was $120 a share and we had $60 a share in cash that was generating zero yield. If we had returned all the cash to the shareholders, we'd have a $60 stock and the company would be growing 5% a year. Instead, we converted the cash through a series of Dutch auctions, share buybacks, and stock and debt offerings into a company we're now growing our top line 10% in the last quarter. The stock is up by a factor of 5. We've made billions of dollars for our shareholders, and we have $3.5 billion worth of Bitcoin. If it goes up 20% a year, we'll make more off the Bitcoin than we could have made in a decade off of the existing business. So yeah, it's different. There's some volatility, but the stock sometimes moves more in a day than we could have hoped it to be at all. So I think our shareholders have benefited, our employees are happy, our customers are happy, and it's a different thing. But, we'd rather be winning with something different than be sitting at $60 a share with no hope.
Any plan to use more debt to buy Bitcoin? And if so, what kind of debt?
Our approach is always to do every financing accretive. So when our stock was 120, we bought it back at 140 to buy Bitcoin. When our stock got to 300, we sold a convert at 398 to buy Bitcoin. When our stock was 1,000, we did a convert at $1,432 a share to buy Bitcoin. When the stock came back to 500, 450, we didn't want to dilute with equity or convert. So we did a senior secured financing, paid 6 1/8% interest, and we bought Bitcoin. Now, the way that the Bitcoin market moves, the way that the senior debt markets move, and the way the convert debt markets move are uncertain. The one thing that we can be certain of is that if we do another financing, we're going to make sure it's accretive to all classes of security holders within the company.
So there was an if there. That could happen?
Our strategy, Emily, is definitely to acquire and to hold Bitcoin and to do it with our existing cash flows. And we generate $115 million in EBITDA cash flow in the last 12 months. We'll do it that way. And we'll also do it with future debt financings and equity financings to the extent that they're accretive.
Michael Saylor, MicroStrategy Chair and CEO. Good to have you back, Michael. Thanks so much for joining us. Okay, coming up, how Apple and other tech giants are trying to get into the driver's seat of the car industry. We're going to be joined by our own Mark Gurman next. This is Bloomberg. Tech giants like Apple and Google are riding the autonomous driving wave of excitement as they look to secure deals and become leaders in the evolving car industry. Bloomberg's Mark Gurman has been tracking the big tech companies and their latest car plans. And Mark, you make an interesting point that these companies aren't pursuing self-driving cars because it's fun, but because they need to defend their turf. What do you mean by that?
Thank you so much for having me, Emily. So let me break this down for you. Google is far and away the leader in self-driving car technology at this point with Waymo. They're already on some roads in the Bay Area. They're already gaining some popularity in Phoenix, right? Google also, has their online search engine. They have online shopping. They sell phones. They sell home devices. They compete against Apple, Amazon, Facebook, and so many other areas, right? It only takes being the market leader in one sector to bring people to your other products. So for instance, Waymo explodes in popularity, right? People who own iPhones might start, being appealed to the Google brand, right? And they might say, you know what, I'm gonna ditch my iPhone for a Pixel phone. I'm gonna get rid of my Amazon Echo for Google Assistant devices. Instead of buying stuff through Amazon, I'm gonna buy stuff through Google now because I'm so impressed with Waymo. And this has to do with ecosystem lock-ins. Companies want you to be in their entire ecosystem. They want you to use their hardware, their services, their software, online shopping, search engines, all that. So this is really becoming a battleground where all the big tech companies are going to need to compete, just like they all compete in phones, in operating systems, online commerce, and just about everything else we talk about on this show every day.
Now, we know that Apple, is not always first, and the saying is they aren't always the first, but they are always the best. What would Apple's competitive advantage in cars be, given that they are, as far as we know, pretty far behind?
I mean, I will disagree with you, just to be fair, on Apple being the best. I think they've basically completely failed so far in the smart home after being multiple years late to that. And in terms of the self-driving technology, I think that Google has shown so much promise. Also, Amazon has shown promise with Zoox and their other, more enterprise initiatives for self-driving or business use cases. We have not seen much from Apple to date. We have seen some reports they filed with the DMV as required to show their performance. They've improved significantly, but they're nowhere near the performance that you're seeing from, Cruise, for example, or Google or some of the other big players. So I think the takeaway here is that Apple is going to get into self-driving cars. And the question is not, the question is not if, it's really when. And my take is that it's going to be at least 5 years away because they really need to get the self-driving technology down. And even then, I don't think their first iteration is going to be a fully autonomous car. I think we're many, many years away from that, 10, 15 years from being able to put your address in and your car taking you there, right? The question for these engineers at these companies is, would you be willing to put your baby in the backseat of a car, plug in the address to take the baby to, and let the car go? Right now, it's a no, but maybe in 10 years.
Well, when you put it that way, Mark, definitely going to think twice or 3 times. Our Mark Gurman, as always, don't forget, you can subscribe to Mark's weekly Power On newsletter for everything you need to know about Apple consumer technology, devices, apps, and even get his occasional thoughts on the NBA. He's a Lakers fan, but we'll forgive him. The first one comes out this Sunday. You can sign up at Bloomberg.com. All right, coming up, we're going to hear from the CEO of one of South America's most dominant e-commerce platforms about how it's changing the way Latin Americans pay and shop. This is Bloomberg. The pandemic forced one of Latin America's most dominant e-commerce platforms to react quickly when cities in the region shut down and consumers moved online. In this week's Retail Transformed segment, our Eric Schatzker speaks exclusively with Mercado Libre CEO Marcos Galperin about the company's growth and the future of online shopping.
I think the outlook for the company continues to be the same regardless of the pandemic. We believe e-commerce will continue to grow its share of total commerce. We're gonna finish 2021 slightly north of 10%, maybe 12%. That's still relatively low compared to where this is in the US or in the UK or in China. So we believe e-commerce will continue to grow. Hopefully stores will reopen and life will go back to normal, and e-commerce will continue growing at the rates it was growing before the pandemic, which was close to 30%.
So not the 100% that we saw over the past year.
Yeah, exactly. The 100% we saw last year, I think, accelerated our growth. Moved us forward maybe 3 years. But I think that once everything reopens, we will go back to the growth rates we had before the pandemic. But we will continue to grow faster than offline commerce.
Mercado Libre runs a marketplace, your original business. You manage a payments network, you provide credit, you have a logistics business. What's next? Well,
that's a lot, and we still need to do many things in those areas. In e-commerce, we believe live streaming is becoming very important. Groceries and fresh are becoming very important. In fintech, we believe DeFi is going to have a major role in the coming years. And overall, we are rolling out many of our solutions. We have 15 million loans outstanding in the region, but there's still a lot of room for growth there. Insurance is something that is starting to grow a lot. So we're just starting.
Mercado Libre CEO Marcos Galperin there. Coming up, Antitrust Showdown. The House takes up a series of bills that could change the internet as we know it. Meantime, tech giants mount their defense. We'll have the latest. This is Bloomberg. Welcome back to Bloomberg Technology. I'm Emily Chang in San Francisco. This week, the House Judiciary Committee approved an antitrust bill that would force large tech companies like Amazon to exit certain businesses. This is a signature proposal within a package of measures aimed at reining in big tech and spurring competition in digital markets. Let's get some analysis with Techonomy founder and our Bloomberg contributor, David Kirkpatrick. David, this would mean that, for example, Amazon could be forced to sell off its logistics business. So it's a big deal if something like this passes. How significant is it?
Well, it's very significant, but I think even what you said is a little bit unknown. What these bills would actually do is not entirely clear, even though if you read the text of one of the bills, it does sound like it could require Amazon to say, get rid of AWS or get rid of its airplanes and all that, its logistics side. Because specific companies aren't mentioned in the bills in terms of what the impact it would have on each of them, it's hard to know how they would be interpreted. But my view of the whole exercise is that, in a way, this is more of early shot over the bow than the, dotting the I's and crossing the T's of final legislation. We are a long way from these bills being law.
Indeed. So obviously you need alignment in the House. You also need alignment in the Senate. But it seems like we're starting to see that. I sat down with Senator Amy Klobuchar, the counterpart of David Cicilline in the Senate. She says she's working on companion bills. She's got bills of her own and agrees that big tech needs to be reined in. Take a listen to part of that conversation.
I love capitalism, but I always believe that you need to put some guards around it when it comes to ensuring capitalism works.
David, you've covered the tech industry for a long time, David. What do you make of the bipartisan momentum here at a time when hyperpartisanship almost tore our country apart?
I think it's a little misleading, unfortunately. I would love to think there was bipartisan agreement that these companies were too powerful and that we needed a range of restraints to make sure that the behavior they exercise in our society and even globally is positive for all of us. But to be honest, first of all, in the Senate, the chances that they'll have 10 Republicans join in passing certainly more than one or two of these bills is very small. But second of all, even in the House, most of the Republicans who are in favor of these bills still are thinking of their grievance with these companies to primarily be that they suppress conservative speech. And they're in favor of anything the companies don't like because they don't like the companies for that reason. So it's not as clear cut. The Democrats, on the other hand, have done much more serious research and I think have articulated very deeply considered positions, as was evident in the many hearings that the House Antitrust Subcommittee of the Judiciary Committee had over the last year or so. So the motives are very, very different. I do think these companies are going to change their behavior, whether because of law or not, in coming years. So in a sense, the whole thing is a positive exercise, but don't count on these laws becoming enacted.
I'm surprised you're so optimistic about that because we haven't seen much self-regulation over the last couple of decades. What makes you so sure that now is the time?
I disagree. Look at Facebook's oversight board, for example, which is it's a partial effort. It's not sufficient. It's only helping a little bit, but it is a major shift in the approach that most dominant company in communications and media globally is taking towards how it operates its business. And I think it's the first of a number of such efforts. I mean, I see three ways that these companies are going to essentially become reformed to one degree or another. First of all, these bills, whether they pass or not, are indicative of a change in the mindset. And the regulators, like Lina Khan, the new head of the FTC, she's going to do more because she knows that Congress has her back, whether these bills are passed or not. Second of all, these kind of regulations are happening globally. In the EU, the Digital Services Act, the pressure is on these companies. They have to reform themselves. But third, as Mark Gurman was saying earlier regarding cars, they're competing with each other more and more. So they're going to be able to rightly say, competition does exist.
Okay. All right. I hear you on that. We'll see. Much more to come. Techonomy founder and our Bloomberg contributor, David Kirkpatrick. Always good to have you here. All right. Meantime, while the plan was to go public this month, Robinhood has seen its listing plans slow down in recent weeks. The delay due to a back and forth with regulators over its prospectus. Sources telling Bloomberg that Robinhood's growing cryptocurrency business has drawn questions from the Securities and Exchange Commission. I want to bring in Bloomberg's Katie Roof, has been reporting on this story. Katie, is this unusual, what's happening between Robinhood and the SEC, or does this happen a lot behind the scenes and we don't necessarily notice because it's not a Robinhood?
Yeah, good to be with you. So yeah, sometimes this happens behind the scenes and it wasn't as noticeable in recent years because of the Jobs Act, which causes the confidential filings to be handled behind the scenes. So the revisions that happen are worked out quietly, but what is unusual is how long it's taking. You know, we were expecting this in like May and then June and then July, and now we're hearing it may not even go public in July. They're trying, but they're waiting on the SEC. You know, obviously Robinhood is a big company. You know, it's in fintech and there's a lot of regulatory concerns. So it does make sense that the SEC has questions, but it sounds like it's a lot more than what they were expecting.
Is this any cause for concern for Robinhood investors?
So I would say probably not. I mean, if you have concerns about Robinhood's business already, this is probably less relevant. I think, if anything, the people that are concerned about Robinhood, they're more concerned about how they handled GameStop and what have you. This is just, you know, the SEC wants clarity and the risk factors and things like that for the filing, just to make sure that they are adequately warning people of anything that can go wrong. But I think it's pretty common for IPOs to have a little bit of a back and forth with the SEC. We saw Coinbase, they were pushed back from March to April because of stuff like this. And then Affirm tried to go out last December and they got pushed to January. They've been slower lately because of so many IPOs that are happening right now, and SPACs as well. So it's been slowing the process down a bit.
So if you could guess, July or August?
Probably not August. I was told, if anything, if they don't go by July, they would push it to September. A lot of times the bankers are in the Hamptons in August. I mean, obviously this isn't a typical year, but it's kind of a dead month for IPOs, and they pick back up after Labor Day because, with your investor roadshows where you're trying to get, these big institutional investors to join in, you really want them to be present and able to participate in these meetings. And if everyone's on vacation, it's usually considered a bad time to IPOs. So, maybe July, but it's up to the SEC.
Well, we'll be here in August, you and me. So if it happens, we'll be ready. Bloomberg's Katie Roof, thank you.
Thank you.
Okay, coming up, why one AWS president jumped ship, how she plans to use her new role to drive more people to the cloud at a new company. That's next. This is Bloomberg. Instagram is testing a feature that lets users post photos and videos from their desktop. Since it was founded in 2010, Instagram has resisted building a web version of its product because it had wanted it to be used by people on the go. But over time, professionals and influencers are spending more time on content creation and using third parties' tools to upload their posts. Instagram also facing increasing competition from TikTok and YouTube. Well, from one cloud to the next, Teresa Carlson, former president at AWS, has left the boat to tackle a new role as Splunk's president and chief growth officer in the ever-evolving cloud space. Joining us now for more on the move, Teresa Carlson herself. Teresa, I'm so glad you're here. You were a rising star at Amazon, a huge and growing business. Why leave Amazon to come to Splunk?
Well, demand for data has never been greater. And Splunk has the most powerful data platform in the world. So it's exciting to be here. And it's also really fun to be part of a high growth company that is still building. And by nature, I'm a builder and I'm an innovator. So it's really exciting to be here. And we are so focused on our customer success to get them to the cloud. I thought, what a better role for me than to help our customers move to the cloud faster.
How will your experience at AWS drive Splunk's sales, success, and growth?
Well, if you look at my experience at AWS, I spent the last almost 11 years in a really high growth business around the world looking at different markets. I built our public sector market from zero to billions. And then I took on our industries, our highly regulated industries. So I think that uniquely will help me understand how to expand markets here at Splunk, based on my background at AWS, but also really I spent a lot of my time helping the customers innovate and go through their digital journey. And here at Splunk, if you look at our last quarterly earnings, 83% of our software bookings were in cloud. So we are well on our way in these last 2 years, but we still have a lot of customers that are moving to the cloud and many more that want to come on the Splunk cloud platform. So with my background at AWS and just really understanding the digital journey and how customers think about this and the migration patterns, I believe that I'm going to really be able to help Splunk actually move a little bit faster in those areas just because of my background and knowledge.
Now, Silver Lake recently announced a $1 billion investment in Splunk. What exactly does that mean?
Wow, we are so excited about that. I think that's just another example of what investors are considering with Splunk, which, yes, they just made $1 billion investment in Splunk, and they could invest in anybody in the world. And they looked at us and said, we believe Splunk has a much higher growth potential. So Emily will be using that fund to continue to accelerate our growth initiatives. But in addition to that, we also announced a $1 billion stock buyback. So that's kind of a double. And then Ken Howe will be our new board member from Silver Lake, who is the chairman there. So we're super excited about that. And we believe that will hopefully bring other investors to the table that understand high tech and high growth.
So, I know this is a big question, but in a nutshell, as people come back to the office, life goes back to normal, what sort of post-pandemic growth do you see in the cloud? Do you see the acceleration that we saw over the last year starting to slow down, or does it just keep getting faster and the cloud keep getting bigger?
Yeah, that's a great question, Emily. In my experience, I've only been here 8 weeks, but my experience prior tells me that we are not going to see any slowdown. Customers have changed forever. And one of the big things that changed their attitude is I think when a customer cannot get into their data centers, when they can't get to their tooling, their applications, they drive change quickly. And if COVID taught us anything as businesses, that we had to be prepared to be digital, be prepared to work virtually, and be prepared to manage all of our systems at every level in the cloud and digital world. I don't see anything changing at all. And if you look at most companies, they're announcing that they are not going to go back into the office full time. That means all of their workers are going to have to work and interact in a virtual world.
Now, I have to ask you because, since you've left Splunk, left Amazon, there's been a lot of news at Amazon. Jeff Bezos preparing to step down, Andy Jassy preparing to step up, Adam Selipsky being hired as the CEO of AWS, and Jeff Bezos planning to go into space next month. What's your take on all of this?
Well, I can just tell you, Amazon is a fantastic company. I worked for Andy Jassy the last almost 11 years. I'm a huge fan of his. I think he is that Amazon is not going to miss a beat with Andy at the helm, for sure. And Jeff going into space, wow, I'm so excited. One of my final things I did at AWS was start an aerospace and satellite business unit. So I was thrilled because I was like, okay, because I do believe in Jeff's philosophy that space is the next new market for us to be in. And I'm absolutely sure Splunk is going to be there. So it's definitely the new space that we're going to be in. So I'm excited for Amazon, and they're a big partner of ours here at Splunk.
Well, we actually had Clint Crozier from that unit at Amazon join us earlier this week. So familiar with what you're talking about and what you worked on there, but we'll be following your work at Splunk. Teresa Carlson, Splunk President and Chief Growth Officer, thanks so much for stopping by. Okay, coming up, the competition over space tourism heating up as the FAA gives Virgin Galactic approval for customer space flights for the first time before Blue Origin has permission for Jeff Bezos. We'll bring you all the details on that next. This is Bloomberg. British regulators are investigating whether Amazon and Google failed to protect consumers from fake reviews on their sites. The companies are facing intense regulatory scrutiny across Europe as authorities crack down on the power of U.S. tech giants. 2 months ago, Facebook removed 16,000 posts dealing in fake or misleading reviews after the UK antitrust regulator intervened. Meantime, shares of Virgin Galactic soaring after the company received regulatory approval to fly customers into space. For all the details, we're joined by who else but Bloomberg's Ed Ludlow. Big victory for Branson today.
It's a big victory, and it's a really big step forward for commercial space flight or civilian space flight. It's the first time the FAA has regulated for a customer, a civilian, to go into space. It all goes back to May 22nd when Virgin Galactic did that test. The first thing they did was hand over the data to the FAA. Here we are in late June, and it gives you an idea of how the process works. And they beat out Blue Origin and Jeff Bezos that are doing a slightly different mission, a very different kind of rocket system, but it's bragging rights between two billionaires who want to go into space, right?
Right. And so if Bezos doesn't have FAA approval yet, I mean, could he not get it in time for July 20th?
So what we know is that this is officially the first FAA approval, but that Blue Origin has an application. And in my experience, the FAA can cut it fine. If you think of, for example, SpaceX, satellite launches, sometimes the FAA will give their approval on the day of or the days leading up to it. I don't think there's any doubt that Blue Origin will get it, but it's still pending, and so there's some tension there until it's official.
Now, talk to us about, remind us how Virgin Galactic and Blue Origin and SpaceX are all different.
Yeah, the business models are different, what they hope to achieve, but the rockets are different too. So for Virgin Galactic, there is a dual fuselage aeroplane that carries the spaceship to 50,000 feet above the Earth's atmosphere. It separates, and then the rocket system kicks in for the rest of the way. And it's just, for the consumer, for the customer, a few minutes of weightlessness in space. They also want to sell to sort of scientists and researchers who want to experiment in zero gravity. Then Blue Origin and SpaceX, they have such broader ambitions: interplanetary travel, satellite-based internet, delivering satellites for NASA and the military, things like that. So Virgin Galactic's system is different, but their focus is different too. They have a much more limited long-term ambition, although it seems like they're making headway on it.
So let's talk about the business model then. How does Virgin plan to make money?
Yeah, so we know that there's around 600 people on the waiting list for this kind of 55 miles above Earth, few minutes of weightlessness experience. They charge around $250,000 a pop. For the research side, one of their test missions later in the summer, for example, is with the Italian Space Agency. It's a few minutes over the course of a total 90-minute mission where they can experiment with healthcare-related technology. That's $600,000 a pop. They say those costs will come down, but these guys are in R&D phase. They're still in pre-production on their actual vessels. And until they get into serial production, the economics can't really come down in terms of price.
And what does that mean for Blue Origin in terms of their economics?
I think, Blue Origin will only have the auction to go off, almost $30
million.
Yeah, exactly, to go into space. They also have other parts of their business which they hope will eventually be revenue generating. The best guy we have to go on is Elon Musk. He says for SpaceX, the launch side of the business tops out at $3 billion a year. Starlink, the space-based internet business, $30 billion a year. So it's really about finding higher margin database services that can kind of fuel that activity of launching into space.
So who are the billionaires outside of Musk, Bezos, Branson that are betting on space?
Well, the billionaires are actually the institutional investors themselves. If you take SpaceX, Sequoia led the last round. You have Fidelity, BlackRock, these legacy names of institutional investment. Cathie Wood and ARK. And then you have ETFs, right, where equity investors can buy into ETFs. You also have, bear with me, Zuckerberg, because one of the big beneficiaries of space, according to investors, could be Facebook. The more that you connect people digitally with Starlink, with Blue Origin's offering for space-based internet, you could see adoption of Facebook, Netflix go up. So, there's a lot of capital coming from a lot of places, but it's Bezos, it's Musk, and it's Branson leading the way.
And what are the chances that Richard Branson gets up there before Bezos does?
We don't know, but I would wager that it's pretty good. We know that over the course of the summer, they want to run 3 test flights. I bet you he's aware of Bezos' launch, and now he has the approval. All eyes on Branson as much as it is on Bezos.
And why hasn't Elon Musk done it yet?
He has this saying, he wants to die on Mars, not on impact. In other words, he wants to make sure that his rocket works and can land safely and take off again before he gets on it.
So what are the next big milestones you're following? We're a month away, less than a month away now from this Blue Origin launch, and they made a big deal by picking a date and telling the world that Bezos would be on it, and they've got someone who's paid a lot of money to be on that flight. So what's next?
I want to know who that person is. I want to know who the auctioneer is. I have some guesses. I won't say who they are. FAA approval. And then, the thing is about the other space players, SpaceX in particular, what they're doing now has become routine, servicing the International Space Station. Elon Musk plans his first civilian launch at the end of this year with Shift4 Payments CEO. I want to see if that's on track too.
I want to know your guesses. Give me one.
I would say it's maybe another billionaire with an interest in space, but who knows?
Somebody who has at least
some money, yeah.
Exactly. Okay, Ed Ludlow, thanks so much. Always good to have you here on the show. And happy Friday. Happy Friday, everyone. All right, meantime, the CEO of the world's largest chip maker says the shortage of semiconductors will get worse before it gets better. That is Intel's Pat Gelsinger, who predicts the effects of the chip shortage to many industries, from autos to consumer electronics, will bottom out in the second half of the year. Longer term, he expects the chip industry to grow with increased demand from the manufacture of 5G phones, EVs, and expanded artificial intelligence. And that does it for this edition of Bloomberg Technology. I'm Emily Chang in San Francisco. This is Bloomberg.